Hello everyone. In the last two parts we talked about depreciation and the different methods of depreciation, including straight line, double declining balance method, and the units of production or units of activities method. Sometimes we call it units of activities, sometimes we call it units of production. So now we want to talk about partial year depreciation. So what if we purchased the asset during the year, not on January 1st of the year? Because assuming that we purchased the asset at the very beginning of the year is very limiting. But in reality, companies, they buy long-term assets anytime during the year. So sometimes we need to calculate partial year depreciation. And in this part here, we're going to go over the journal entry and the calculations for the partial year depreciation. So a fixed asset may be purchased and placed in service other than the first month of an accounting period. In such cases, depreciation is prorated based on the month the asset is placed in service. So assets may also be placed in service other than the first day of a month. In such cases, assets placed in service during the first half of a month are normally treated as having been purchased on the first day of the month. Likewise, assets purchased during the second half of a month are treated as if or as having been purchased on the first day of the next month. So this is a way of trying to simplify the calculation for mid-month purchases. So under the straight line method, depreciation is prorated based on the number of months that the asset is in service. So let's see an example. Assume that Exter Company purchased the forklift on October 1st instead of January 1st. So in this case, the first year depreciation would be based upon 3 months. Because remember, this is October 1st, so we have to count October, November, and December. So it would be $1,100. And how did we get that? Again, we got the original cost minus the salvage value divided by the useful life, and that would be $4,400. But the $4,400 is for the full year. We want to get the fraction of the 3 months of that year. So 4,400 multiplied by 3 divided by 12, that would be $1,100. If we're applying the units of activity method, in this method, it computes depreciation expense using an activity rate and the activity level of the period. So let's say, again, another example. Assume that Exter purchased the forklift on October 1st instead of January 1st. And assuming that during October to December, the forklift was only used for 400 hours. So in this case, it's easy. We're going to calculate the depreciation per hour first, or the depreciation rate per hour, which is, in this case, again, the $24,000 minus the residual value of $2,000 divided the expected number of hours to be used for that forklift, which are 10,000 hours. So that would give us a rate of 2.2. So we take the 2.2 multiplied by 400 hours that were used during the 3 months, starting October until December 31st, and that would be 880. So again, you can see here, we just got the rate as we've done before, and we multiply it by the number of units or the number of hours that has been used. What if we're using the double declining balance method? So like the straight line depreciation, if an asset is used for only part of the year, the annual double declining balance depreciation is prorated based on the number of months the asset is in service. So again, let's use the same example. Assume that Exter forklift was purchased and placed in service on October 1st instead of January 1st. So in the first year, depreciation would be based upon 3 months. And remember, in the double declining balance method, we have to get the annual rate, which is 100% divided by 5, and then we multiply by 2 since it's double. So it's 40%. We take the 24,000 without deducting the residual value and multiply by 40%, and that would be 9,600. Then we take the 9,600 multiplied by 3 divided by 12, and that would be $2,400. So for the first 3 months, it's going to be only $2,400, which is prorated based on the full year multiplied by the fraction of the year. So what are we going to do in the second year? The second year depreciation would be computed by multiplying the book value on January 1st of the second year by the double declining balance rate. So let's see, assume that Exeter purchased the forklift on October 1st and the 2400 partial depreciation was recorded on December 31st. Now the new book value is 21,600. How did we get it? It's the $24,000 original cost minus the accumulated depreciation, which is based on the depreciation for the last 3 months, and that would give us 21,600. We take the 21,600, multiply by 40%, and then for the full second year it's going to be 8640. So that's how the partial depreciation is calculated. I don't think it's too complicated. I think it's just if we try it and practice it a couple of times, it's going to be very easy. Now let's talk about revising the depreciation estimates, because estimates are based on previous experiences, and sometimes down the road we might feel like there is a need to change these estimates, or our estimates were a little bit optimistic, or maybe we're aggressive in our estimates, so we need to make some change in our estimates. And generally accepted accounting principles allow you to revise your depreciation estimates as long as you have a reasonable reason to do that. So estimates of residual value and useful lives of fixed assets may change due to abnormal wear and tear or obsolescence. So when new estimates are made by management, they are used to determine the depreciation expense in future periods. The depreciation expense recorded in earlier years is not affected. So whatever is done before is done. We don't go back in time and change it. So, but from the date we decided to change the estimate, this is where we are going to apply the new estimates. So let's assume that the following data for a machine that was purchased on January 1st is as follows. So we have the initial machine cost to be $140,000. We have expected useful life of 5 years and estimated residual value of $10,000. So assume that we're using the straight line method. So the cost minus residual value would be 140 minus 10, which is 130,000. Divided by 5 years, that would be 26,000 per year. So at the end of the second year, the machine's book value is $88,000. So this is the undepreciated cost up to date. So remember, it's $26,000 per year. We have 26,000 for the first year. For the second year, that would be a total of 52. If we deduct 52,000 from the 140, the book value after the end of the second year would be $88,000. So again, 140, 26 multiplied by 2. This is the accumulated depreciation, which is 52,000. We deduct the 52,000 from the 140, and we get $88,000. So at the beginning of the third year, the company estimates that the machine's remaining useful life is 8 years. Okay, originally we were expecting it to be 5 years. So now we expect that the useful life is going to be 8 years instead of 3. So we extended it with another 5. So the original estimate was 5, now it's 10. We already used 2, so there are 8 years left. So, and the residual value would be 8,000 instead of 10,000. So in this case, we treat the asset as if it's a new asset. So we revise the depreciation using the new book value minus the new expected residual value divided by the new expected remaining useful life. So our book value at the beginning of the third year was 88,000. We subtract from it the new or the revised residual value divided by 8 years. So it's going to be $10,000. 88 minus 8,000 divided by 8 years, that would be $10,000. So if we go back, it used to be $26,000 because it was only limited to 5 years. Now since we extended the useful life, it's going to go down to 10,000 per year. We are done with the first 2 years. So for the first 2 years it was 26,000, and then starting year 3 till year 10 is going to be only $10,000. So this graph here gives you an idea. So the original cost was 140. After year 1 we subtracted 26,000 to get the net book value, and then another 26,000, and then it kept going down by only $10,000 every year until year 10, where the residual value would be only $8,000. Now let's shift gears a little bit and talk about a topic that's not related to depreciation, but it's related to fixed assets, which is repairs and improvements. So once a fixed asset has been acquired and placed into service, costs may be incurred for ordinary maintenance and repairs. Costs may be incurred for improving an asset or for extraordinary repairs that extend the asset's useful life. So cost that benefits only the current period, we call it revenue expenditures. I want to remember that. The name is a little bit tricky. So these are still costs, but we call them revenue expenditures. And the reason we call them revenue expenditures, because these are costs that we incur to generate revenue. So we call them revenue expenditures. And then we have costs that improve the asset or extend its useful life, and these are called capital expenditures. And again, why we call them capital expenditures? Because these are costs that would enhance the capital of the business. In other words, it's another form of saying assets. So if the cost is added to the cost of the asset, we call it capital expenditure. If the cost is considered to be an expense because it ties directly to revenues, we call it revenue expenditure. So costs related to the ordinary maintenance and repairs of fixed assets are recorded as an expense because these are revenue expenditures. So such expenditures are revenue expenditures and are recorded as increases to repairs and maintenance expense. So if we see an example of $300 paid for a tune-up of a delivery truck, this would be recorded as debiting repairs and maintenance expense and crediting cash. So you think this is a cost that we incurred related to a truck, but yes, it's only a tune-up, which is a regular kind of maintenance. So we just include it as an expense. We don't add it to the cost of the truck. So these are repairs and maintenance on the debit side, repairs and maintenance expense, and then we credit cash because that's how we pay the cash. How about extraordinary repairs? So after a fixed asset has been placed into service, costs may be incurred to extend the asset's useful life. So let's say I have a truck that has been used for several years. Now it needs a new transmission or a new engine, and that's going to extend its useful life. So in this case, we're going to reduce the value of that accumulated depreciation by debiting the accumulated depreciation and crediting cash. So let's see an example. The engine of the forklift that is near the end of its useful life may be overhauled at the cost of at the cost of $4,500. So extending its useful life by 8 years. So such costs would be considered to be a capital expenditure. But not all capital expenditures are recorded the same. When we have extraordinary repairs like something like that would extend the asset's useful life, we're going to follow or use the following journal entry. So we debit accumulated depreciation for the forklift and we credit cash. So that way we're reducing the value of the accumulated depreciation. Of course we're paying the cash, but we're not touching the asset itself. So the forklift is not affected by this journal entry. It's only the accumulated depreciation of that asset. What if it's an asset improvement? So something that would make the asset more productive. It's not something that would enhance its useful life or extend its useful life. It just enhances its productivity. So after a fixed asset has been placed into service, costs may be incurred to improve the asset. So for example here, the service value of a delivery truck might be improved by adding a $5,500 hydraulic lift to allow for easier and quicker loading of cargo. Such cost is still a capital expenditure, but it's recorded in a different way. We are going to debit the asset itself, not the accumulated depreciation. Why? Because that's an asset improvement. It's not like the previous case where we have extraordinary repair. This is an asset improvement. So we debit delivery truck and we credit cash. So we have a nice decision kind of diagram that will give us an idea how we decide how we treat the cost. So if we have a cost that's related to an asset, we have to ask ourselves, is it going to benefit only the current period or is it going to benefit current and future periods? If it's only the current period, then this is just regular maintenance and repairs. So it's a revenue expenditure. We debit repairs and maintenance expense and we credit cash. So if the costs related to fixed assets benefits current and future periods, then we have to ask ourselves the second question. Are these considered to be extraordinary repairs that extends the useful life, or are they assets improvements that add service value to the asset? So if it's an extraordinary repair, then we capitalize the expenditure, but the journal entry for that would be by debiting the accumulated depreciation and crediting cash. But if it's an asset improvement, then this is something that adds service value to the asset. In this case, we also get to capitalize the expenditure, but the journal entry would be slightly different. We're going to debit fixed assets itself and then credit cash. Now let's talk about the disposal or getting rid of the fixed asset. So fixed assets that are no longer useful may be discarded or sold. In such cases, the fixed asset is removed from the accounts. So if a fixed asset is no longer used and has no residual value, it's discarded. So the term that we use in accounting is discarding the fixed asset. So discarded asset and its accumulated depreciation are removed from the accounts and the ledger. So we have to get rid of the asset and its related accumulated depreciation account. So let's assume the equipment acquired at a cost of $25,000 is fully depreciated. In other words, its accumulated depreciation is equal to its cost. So on February 14th, the equipment is discarded, and the entry to record that discard is as follows. We're going to credit the equipment. When we credit the equipment, we're reducing its value based on its original cost, and we're also going to debit accumulated depreciation. Remember, accumulated depreciation is a contra asset account. So it has a credit nature. When we debit it, we are canceling it, especially that we are canceling it for the full value. So if an asset has not been fully depreciated, depreciation should be recorded before removing the assets from the accounting records. Assume that equipment costing $6,000 with no estimated residual value is depreciated at a straight line rate of 10%. So in other words, it's good for 10 years. But it doesn't have residual value. The accumulated depreciation balance after adjusting entries is $46.50. On December 31st, so the balance of accumulated depreciation was $46.50. On March 24th, which was after 3 months of this date, the asset is removed from service and discarded. So the first thing we need to do is to calculate the depreciation expense for these 3 months and add it to the accumulated depreciation. And then we are going to see how much is the book value of that asset after we update the accumulated depreciation. So the first journal entry here is to record the depreciation for the 3 months before asset is discarded. So as we said, it's going to be $600, which is the annual depreciation multiplied by the 3 months. And remember, it was this March 24th. We're going to round it up to March 31st. So it's going to be January, February, and March. So that would be 3 months. We multiply by 3/12, and it's going to be $150. And we just do a regular depreciation expense account. We debit depreciation and we credit accumulated depreciation. Then we discard the equipment as follows. By getting rid of the equipment for the full value, $6,000. Then we also get rid of the accumulated depreciation for the equipment. And remember, it was $46.50. We updated it with $150, so the total now is $4,800. And now there's a difference. There's still a balance of $1,200. And since we discarded the fixed asset, we're going to record the difference as a loss on the disposal of the equipment. And losses are treated very similar to expenses. They appear on the debit side. If you have a gain, it's recorded on the credit side. But of course, when we discard an asset, there's never going to be a gain because we don't receive cash. In the second scenario, or the coming scenario, we're going to sell the fixed asset. In this case, there might be a gain or loss depending on whether we are selling this fixed asset above or below its net book value. So the entry to record the sale of a fixed asset is similar to the entry for discarding an asset. The only difference is that the receipt of cash is also recorded. So if the selling price is more than the book value of the asset, a gain is recorded. If the selling price is less than the book value, then we have a loss. So this is how simple it is. So assume that an equipment is purchased at a cost of $10,000 with no estimated residual value and is depreciated at a straight line rate of 10%. Again, 10 years is 10%. Get 100% divided by 10, that would be 10%. The equipment is sold for cash on October 12th of the 8th year of its use. So in this case, we're going to round it to October 1st, and that would make it 9 months. The balance of the accumulated depreciation account as of the preceding December is $7,000. So the entry to update the depreciation for the 9 months would be as follows. So first we need to update the depreciation by debiting depreciation expense and crediting accumulated depreciation for the equipment by getting the 10,000 multiplied by 10% multiplied by 9 over 12. And why it's 9 over 12? Because we're calculating from January till September 30th. Since this is before October 15th, we don't count October. So we end on September 30th. So in this case, we're multiplying only by 9 over 12. So before I move on, so now how much is our updated accumulated depreciation? It's the 7,000 plus the 750. So after the current depreciation is recorded, the book value of the asset would be 2,250. How we got it? It's the 10,000, which is the cost of that asset, minus the updated accumulated depreciation, so the book value is 2,250. So the entry to record the sale, assuming 3 different scenarios, would be as follows. So let's assume that we sold it for exactly its book value. So we got a cash of 2,250. We get rid of the equipment, so we debit cash for 2,250. We get rid of the equipment on the credit side by $10,000. We get rid of the accumulated depreciation for equipment for $7,750. The debit side and the credit side are matching now. What if we sold it for a value below its book value? Then in this case we sold it for a cash of $1,000. So the cash is $1,000. The equipment we credited for $10,000. We get rid of its related accumulated depreciation for $7,750. So now the debit side has $8,750 and the credit side has $10,000. So we have a loss of $1,250. Remember, if the plug-in value or the difference is on the debit side, it's a loss on the sale of equipment. And it makes sense. We have something that has a value of $2,250. We sold it only for $1,000, so we end up having a loss of $1,250. What if we sold it for a value above the $2,250, which is $2,800? Then in this case we'll have a gain of $550. And again, the journal entry would be debiting the cash for the $2,800, crediting equipment for $10,000, debiting accumulated depreciation for $7,750. The debit side now is $10,550. The credit is $10,000. So we credit the difference by $550, and that's going to be called gain on sale of equipment. And now the debit and the credit match each other. Okay, so let me stop here. In the next video we're going to be talking about natural resources.